Welcome back to Business Week here on Arise News. Now, Nigeria's equities markets closed 2025 on a historic high, delivering its strongest performance in 5 years as investors rotated aggressively into stocks amid inflationary pressures and negative real yields. Now, according to a new market review by SEMTL Research, the NGX All-Share Index recorded a year-to-date return of over 51%, while total market capitalization expanded by more than 53% to about 99.4 trillion naira. The rally was broad-based with strong gains across banking, industrial goods, consumer goods, insurance and energy stocks driven by macroeconomic reforms, earnings resilience and renewed investor confidence. Joining us now is Dr. Patrick Ejumedia, who is head of research, Sterling Asset Management and Trusts Limited, to help unpack what drove this exceptional run, the risk beneath the rally, and what investors should expect heading into 2026. Good morning to you, Dr. Patrick. Always a great pleasure to have you here. Happy New Year to you.
Yeah, I wish you the same. We're already in the tree already.
Yes, we really are, isn't it? Well, let's begin with the big picture. Okay. You know, as I've just highlighted, 51% return makes 2025 one of the strongest years for Nigerian equities in decades. Yeah. What fundamentally changed in the market last year?
I think for me, I wasn't surprised because at October, I already said that the market was going to do 50.
You had your crystal ball, didn't you?
So I already said, so I wasn't surprised, except for the capital gain tax that came and there was this back wagon effect everybody took. And of course, I still knew that people were going to come back to the market because at that point, the yield, fixed income rates were dropping. And when fixed income rates were dropping, investors will always want high yield on their investment. And that was to bring them back, you know, to the capital market. You know, so back to your question, 51% is very historic, like you said. The last time we had this was in 2020, just the corona year. The corona year, we didn't feel the impact too much because, you know, we started feeling it after the corona. 2021 market drop, growth rate was around 6%. And after 2020, the other time that we had a 50% growth was around 2003. That's about 17 years before 2020 and now 2025. So I think it's a huge historic move, you know, growth that we got there. You know, so what then changed? Basically, I think it's about to improve investors' confidence because of the macroeconomic stability that they were seeing. You know, that played a lot of role to attract investors into the market. Then two, we also saw, you know, at some point after 2024, the government was, the CBN policy rate was very high, even though it's still high now. And that also attracted the yield in fixed income market to also go up and all that. But again, as at 2025, you know, when inflation started coming down and some level of stability in the exchange rate, the government has started cutting rates. You know, so of course, investors will always look for where they will get that high return, and also that diverted them to the equity space. So those are the things that changed and that brought about. And again, those also had a lot of impact on the sectors, you know, the banking sector, the consumer goods sector. You see some consumer goods, despite exchange rate around 1.5, still doing about 129% year-to-date growth. That's also very high. You know, so all of the market insurance, because again, there are recapitalization that is ongoing, also made them to do a lot of growth. You know, so we saw all the sectors grew, and we saw return investors' confidence that made, you know, the market to grow, and then the movement from fixed income to the equity space. Those are the factors that do the
quite literally the seesaw pattern we see there, and of course with a rollout effect. Now, this report describes equities as an inflation hedge. Quite an interesting description around that. Can you explain why stocks became more attractive than fixed income in 2025?
Of course, I think I said at the beginning, I said a little bit of them, you know. Every investors want a return that is higher than inflation, the positive real return rate, you know. So at some point, like I said, in 2024, inflation rate was high. And why was rate high? Government wanted to stabilize the exchange rate. And so because of that, they kept rates high to attract inflows to come. Now in 2025, after the rebasing of the price in the CPI rebasing, inflation started dropping. And when, of course, it's just normal for them to do that, coupled with the fact that Nigerian rate was about the highest in Africa, our NPR rate. So I was saying it that at this point, Nigeria has been favored in the sense that our rate is one of the highest globally, about 27%. Our NPR rate is about 27%. So that alone is significant enough to begin to attract investors to come, you know. So the yield too was high. But when inflation started coming down, government now had to begin to cut rates. Government now had to begin to, of course, they didn't cut the monetary policy rate, which is still at 27%, but they were also playing with the yield. So yield was now coming down. And so investors now saw that, oh, we are not making so much. Inflation is higher than our return that we are getting on fixed income. So again, they now decide to move from fixed income to the equity space. And that's why equity now appears to be that hedge that they're using to hedge against inflation.
And continuity is also quite important. We just spoke about how historic that was for last year. What do you see in your crystal ball for this year?
For this year, I think...
Given what we know happened last year.
Yeah, so for this year, I still feel that the market is a volatile space. If you don't see, it's supposed to be volatile, right? So if it's not volatile, then it's not the market. So it's supposed to be volatile. But for me, the volatility will be volatile upward. Because, again, I don't think the government will go to sleep and allow all the gains that they've gotten for last year to just fade away. So they will all do all they can to ensure that they put it there and they will continue to encourage. Again, will interest rates go up? I don't think it will go up because now most governments of the world, not just Nigeria, they are starting to pursue growth of the economy. So government is looking at that. In the last monetary policy meeting, a lot of people were envisaging that government was going to second cut because people are now saying that, oh, it's high time government begin to look about the growth of the economy rather than pursuing inflation that is already coming down and all that. So for me, I think that rate cuts may continue at this point, particularly not just the monetary policy rate, but also the yield, because once the stop rate in the fixed income comes down, it affects the yield. And once that happens, where will investors go to? They have no option than to begin to look at the equity space. They will go into the equity space. Yeah.
Absolutely. Now, we saw market capitalization grow to about 99.4 trillion naira. How much of this expansion came from new money?
No, I think most of the, new money can come in various ways. One of the ways where new money can come is one that we've been talking about. And I think it's important to start from that point. Once the rate is going up, people take money from equity to fixed income. Now, when fixed income rates, when the yield is coming down, people bring their money again from fixed income to equity. But a large percent of the growth in the market capitalization came from share price appreciation of particularly large cap stocks. Those large cap stocks, the share price appreciation brought about a lot of people, coupled with the strong investors' confidence that they had, brought a lot of people, made the demand for those share price to go up. And that's basically what drove the market. I would say about 70% of the increase in market capitalization came from share price appreciation of those large cap stocks.
All right. Well, let's isolate a few of them. Let's look at banking, industrial goods, and consumer goods, which, of course, led the rally. What sectors level drivers stood out particularly for you? You've highlighted quite a number of them already, in fact, but let's isolate and speak about these ones.
It's interesting. Basically, for me, it's the consumer goods. 129% is about the highest, followed by, I think, the insurance sector, and of course, it's not surprising but for me, why I say the consumer goods is because people would ordinarily think that with high level of inflation is still double digits, right? Even though it's coming down, it's still around 14%, exchange rate, yes, about 1.4, 1.5, and all that, So with those amount of macroeconomic indicators, people will still expect that, this sector should not be doing too well. But they did about 129% year to date last year. So that's interesting. So I think that's for me is about the plus. And that's what we need for now. If we are talking about the type of growth that we are looking for as a nation, we need a growth that can create employment. We need a growth that will bring about the growth of the real sector. And that's where the consumer goods have to play. So that's why for me, that's the sector I would think.
Okay, certainly. And, for known reasons, of course. We spoke about continuity and sustainability earlier because we saw the industrial index also, return over 50%, of course, supported by infrastructure spending, import substitution. But how sustainable are these, again, in the medium term, specifically for these?
I don't think the industrial goods is about 59% year to date, that's last year. And for me, I still think it's going to be very sustainable.
You reckon?
And why do I say that?
Yeah.
I say that because if you had listened to a lot of analysts talk about the amount of infrastructure that Nigeria needs to get to that level of development that we are aspiring to be, people have said that we need to spend certain amount for some amount of years. Some people have said that as 10 years, we need to spend huge amount of money on that sector. Now, if you look at this current budget, the second highest aspect where government put a lot of money is the infrastructure space, about 3-point-something trillion, naira. So that's also huge. So I still feel that as long as we still prioritize infrastructure, that sector will keep to do well. Of course, the growth rate might not be as high because, of course, we'll be achieving some every year, and so the growth rate might be coming down. But for me, I still think midterm is about 2 years, and 5 years, I don't think we are there yet in terms of infrastructure.
That's quite a pill to swallow. Let's look at banking stocks now. Last year, the tune was about the recapitalization drive. We heard that quite a bit. They also performed very strongly amid that recapitalization expectation. But how critical was this recapitalization narrative to investor sentiment?
Yes, it's very, very, I think what many investors look at then, they were buying into the future of those banks. Because I've always said it, that come 2020, this year, 2026, when the process is going to be ending by March, so every investor who is taking advantage in banking stocks are buying into a bigger bank.
Right.
And I can assure you that by the time this recapitalization process is over and we can now see bigger banks, anybody who has bought into it would have seen that you have bought a cheap stock, because their price will definitely come up. So people bought into the future, and that lost a lot of demand in the stock of those banks last year, And so it played a lot of role. It played a lot of role, the capitalization process.
I liked the term, they bought into the future.
Yes,
so, of course, that's always going to be a key driver. But let's juxtapose that against the performance of the oil and gas index, as we know that pretty much underperformed. What drove the divergence between energy stocks and the broader market?
So there are about three aspects that affect the market. There's the macro aspect that has to do with government. There's also the let's say sector-specific factors that can also affect each of the individual sectors. And there are also firm-specific factors that can affect firms in each sector. Now, for the oil and gas sector, the macroeconomic environment was good. But again, the firm-specific factor in terms of oil production, if you look at our Q2 GDP, you will see that oil production dropped. And of course, if oil production dropped, that's going to play a role in those oil firms or the oil sector. And what happened? We've seen a lot of factors why the oil production in Nigeria is dropping. They've termed it to insecurity and all that, So that's one of the factors that led them to not to be able to meet up, coupled with the fact that oil prices is also dropping. So if oil prices was dropping globally and their oil production, the amount of oil production also dropped, there's no way they can meet up in terms of their contemporaries, in terms of other sectors that made significant growth in 2025.
So this was a predictable performance for you?
Yeah, it's not surprising.
It's not surprising.
The only way they would have been able to do that was to increase oil production, so that when oil price is dropping, you supply so much in the market that you can still make your profit. But there was oil production dropping. There was also some level of high cost because inflation is high. Don't forget that the sector is actually very capital intensive, so that can also affect them. So these are some of the factors. So it's not surprising. If they had not been able to increase their production, then there's no way they can net the short, the oil price drop that is coming, coupled with high prices of their production that they face.
So in light of this knowledge and where we are, of course, speaking prospectively for the future and the year, what do you propose oil and gas index for this new year would be?
It's a consign. The only way, because we've seen we saw the budget and the government brought oil production down, and again, there's also speculation that oil prices are likely to drop further in 2026. So the only way to do that, we'll see firms who are able to be more efficient, firms who are able to tackle insecurity issue, because tackling insecurity also comes with a huge level of cost as well. So firms who are able to tackle all of that may do well. So it's not going to be some level of firm-specific factors that can bring about that. So coupled with the fact that, like I said, those firms that are able to tackle security, those firms that are able to be more efficient in terms of their production process and all that are likely to do well.
All right, then. Well, the report also notes a gradual return, as it has stated here, for foreign portfolio investors. How meaningful were these foreign inflows compared to domestic institutional participation?
Yeah, so foreign portfolio investment also increased significantly last year. I was looking at the data and I was seeing about from about 0.8 trillion to about 2 trillion. But that number is not as high as the domestic investors. Domestic investors still have about 8 trillion. So that's still very high compared to foreign investors. But again, I must say that it increased significantly. And of course, it goes back to the stable macroeconomic environment that is building investors' confidence and drove a lot of them to come into the market.
All right, it's always great to look at performance, but then let's also now focus on lessons, because that's the only way to move forward, isn't it? We saw some extreme winners and we saw some extreme losers in 2025. What lessons should retail investors draw from the top gainers and top losers list, in your opinion?
So basically there will always be winners and gainers.
Surely.
Everybody cannot win.
Absolutely.
So I think for me, it's about being able to play their game very well. And what do I mean? I mean, perform their fundamentals very well. Know that, yes, know what stock to invest on at each time. And how do they do that? They have to know, do fundamentals very well, do their technical analysis very well, and then be able to learn their lesson in terms of where did they get it wrong last year, so that they don't repeat, the same mistake this year. And everything boils down to their in-depth analysis of the market, and being able to know what sector and what firm to put their funds in.
Well, sectors that are, for instance, infrastructurally challenged, let's put it that way, where that is just a limiting factor for them, in what ways could they then circumvent and basically address the lessons here?
And so what then happened? That's where we spoke about the efficiency of the companies.
Okay.
So
an internal resolve.
Yes, efficiency is key. If you for every organization, if you at some point where people are competing, particularly what we call a monopolistic competitive kind of market, it depends on how effective you are, how efficient you are in terms of utilization of resources. That will determine how you can raise your head to say you have done well in the market. Otherwise, most companies may be struggling and they might have issues.
Right. So. Again, getting back in efficiency, basically addressing those systems. Yeah. We can't have this conversation without looking at valuation re-rated, which played a major role in 2025, of course. Are Nigerian equities now fairly, priced, or is there still an upside there?
No, of course. Yes, a lot of appreciation happened last year. So some people will say, some stocks are now fairly priced and all that. And that's why some people are saying that, next year or that's 2026, we might not have the kind of growth that we had last year. But for me, I still feel that there will still be a lot of opportunities. Yes, a lot of stocks are now getting to their limit in terms of their pricing, but there are still significant stocks that are still performing below their price. So it's now left for investors to be able to identify those stocks, so that you can look at where to put your money and then know what will happen to those kind of stocks. So I won't say it is fairly priced. I won't say all the stocks are fairly priced. I'll say yes, but there are still some upside in terms of some stocks that can grow.
But valuation rating as basically just a trend last year, do you see that being a recurring one over the next couple of few years?
It can always happen if there is macroeconomic inflation comes up again, exchange rates depreciate further again, so you see it again coming up. As long as once there's stability, you find that stability. Then if there's stability and those companies have not reached their peak in terms of their pricing, you see it. So two things can make that re-rating happen. One, in terms of stability, but yet the company have not reached their peak in terms of their price. Then second is, prices changes. And once prices changes, it's just normal for them to also change their price and get to that level.
Response to the volatility. But let's look ahead at the report here, projecting a bullish 2026, driven by earnings growth and global tailwinds. What are the biggest risks that could derail this outlook? Because it sounds, quite colorful from where I'm sitting right now. Is this a little too ambitious?
Not. I don't think it's ambitious.
Okay.
But like I said, the market is a volatile space.
Absolutely.
And so anybody who just think that, it will just continue to go down or continue to go up, I say no. It's important that you know that as much as it is volatile, but what you should not bother yourself on is where is the volatility moving to. For me, it's going to be volatile, but it will be volatile upward. And that's why I feel that the market is going to go up. So, but what are the things that can make that trending upward reverse? Of course, we saw, like I said, what happened in 2020 when there was Corona. After 2020, 2021, the market dropped. If we see a significant global change in the global space, that can affect this growth that we've talked about. Coming home, if we see, for instance, government, maybe inflation trends upward again, and government decide to reverse its cutting of rate and begin to increase rate, of course, investors will move from that market and they will go to the fixed income space.
As they should.
As they should,
really. So it's all very responsive.
It's about fund, and you want to put your fund in the place that will give you the highest income.
Absolutely. All right, let's wrap up with looking at investors entering the market now. Let's hear from you. Which themes, which sectors would you advise them to, watch most closely in 2026?
again, if we go back to the reports that we put out there, you see that all the sector did well, apart from the exception of the oil and gas sector. So for me, I think all the sectors are very open to invest in. But again, to advise investors is, again, like we said earlier, do your fundamentals very well. Check firms that are efficient. You can, if you don't have that, you then need to look for how to study the books of those firms so that you know, apart from the fact that the sector is doing well, there are some sectors that are doing well, and there are still some firms in those sectors that are not doing well. So you need to identify these firms in those sectors that are doing well, so that you can then know where to put your fund.
Right, make very informed decisions, study the market, study the flow.
That's the word.
Absolutely. Well, if you joined us midway, I've been chatting with Dr. Patrick Ejumedia, who is Head of Research at Sterling Asset Management and Trusts Limited. Dr. Patrick Ejumedia, many thanks for joining us on Business Week, and we'll surely see you again very soon.
Sure, the year just starting.
Yes, absolutely. So see lots more of you. Well, that's all we have time for today on Business Week. I am Abby Owolawi. Let's continue the conversation on X, and do have a lovely rest of the weekend.